Yeah, okay. So let us start today, students, with a new topic in the accounting for financial management. That is accounting for foreign currencies, which is governed by Accounting Standards 11. So let us first take a snip preview of the theoretical part of AS-11. So here it goes. Foreign exchange accounting, which is covered by Accounting Standard 11, involves the recording of transactions in currencies other than the one functional currency. Means if I'm in India and if I'm dealing with someone I'm doing business with someone outside India. So the currency will function according to the Indian rupee. Okay, so it means that. For example, a business enters into a transaction where it is scheduled to receive a payment from a customer that is denominated in a foreign currency, or to make a payment to a supplier in a foreign currency. So if I'm an exporter, or if in the same case I'm an importer also. So if I'm an exporter, that means I have done sales. Okay, so the money that I will receive will be obviously in dollars or in pounds, and I have to convert while recording in India into rupees. Similarly, if I am importing anything from other country, so I am purchasing. So when I am purchasing, I will have to make payment. So when I am making payment, that payment will be recorded in the Indian rupee. Okay. On the date of recognition of each of such transaction, the accountant records it in the functional currency of the reporting entity based on the exchange rate in effect on that date. If it is not possible to determine the market exchange rate on the date of recognition of a transaction, then the accountant uses the next available exchange rate. If there is a change, just a minute. Yeah. So if there is a change in the expected exchange rate between the functional currency of the entity and the currency in which transaction is denominated, we record a gain or a loss in earnings in the period when the exchange rate changes. This can result in the recognition of a series of gains or loss over a number of accounting periods, and the settlement date of the transaction is sufficiently far in the future. Okay, now what does all these things mean? First, that okay, let me before giving you an example, let us just look into the definition of AS-11. Domestic currency or the reporting currency. Okay, that is the currency of the reporting country or currency used in presenting the financial statements. Okay, as I said, if I am dealing, this is India. Okay, I am exporting goods, say to US, and say I am importing goods from UK. Okay, so when I am exporting goods to US, so I am doing sales. Okay, so say today's date is say somewhere around what is okay. Say it is yeah, say the date is 31st of December. Okay, and today's exchange rate was $1. Okay, $1 was say 40 rupees. Okay, right? Today's date is $1, 40 rupees. So say I will be receiving payment on say 5th of January, and that day the rate is $1 equal to 50 rupees. ओके, तो जब मैंने बेचा था उस दिन $US कितना था 40, और जब मुझे पैसा मिलने वाला है उस दिन $US कितना है 50. तो मेरा तो फायदा हो गया ना 10 रुपए का, राइट? क्योंकि अगर 31st को पेमेंट होता तो मुझे 40 रुपया मिलता, लेकिन पेमेंट हो रहा है आफ्टर 4-5 days, सो मुझे 50 रुपया मिलेगा. सो देर इज अ गेन of ₹10. I mean to say this. Okay. It can be opposite of this also. Yeah. On 31st December, say the rate was 40, but say on 5th Jan, $1 became 30 rupees. तो मुझे कम पैसा मिलेगा, तो फिर मेरा 10 रुपए का नुकसान हो गया है. It's a loss. Okay, so you have to think from this point of view. Okay, next, I'll give you the example of import. I give you an example of export. I'll give you an example of import. So I am in India. Okay, same example I'll give. 31st December को मैंने किया परचेज, क्योंकि मैं इंपोर्ट कर रही हूँ, मतलब मैंने परचेज किया. तो उस दिन रेट था 40 रुपया, राइट. तो जब मैं परचेज करूंगी तो मैं पैसा दूंगी, आई विल पे मनी. ठीक है. सो एट द टाइम ऑफ पेमेंट, से ऑन 4th January, the exchange rate became, instead of 40, it became 42. Okay, so don't you think I have to pay 2 rupees more? So this is a loss to me. You can reverse this example. Instead of 42, say it became 35 rupees. So जब मैं पेमेंट कर रही हूँ, मैं 35 देने वाली हूँ, ये तो मेरे लिए अच्छा हो गया. मैं 5 रुपया कम पे करूंगी, तो मेरे लिए तो गेन हो गया. Okay, so this is the perspective under accounting standard 11. Okay, so I hope this part is clear to everyone, right? So second point says foreign currency, currency other than the domestic currency. Like I am in India, so for me the currency is rupees. Okay, yeah, and I am dealing with US, so it is the US dollar, and if I'm dealing with UK, so it is the pounds. Okay. Exchange rate means the rate at which two currencies of two countries are exchanged. As I explained, then opening rate and the closing rate. So the exchange rate that is in the beginning of the year is called as the opening rate, and the exchange rate that is at the end of the year is called as closing rate. An average rate will be opening rate plus closing rate divided by 2. That's the average. Monetary items, money held and assets and liabilities to be received or paid. And non-monetary items, items other than the monetary items. Okay. So this is, yeah. Now comes into picture as per AS-11 is the foreign exchange fluctuation account, which is called as the FEF account. Now this account is opened only to record your losses or gains in terms of conversion of your currency. Okay. So due to the fluctuating exchange rate system, okay, which I just give you a small example earlier, there can be either a loss or a gain at the time of conversion of the money. Okay. So such loss and gain on conversion is recorded in a temporary account, which is called as the FEF account. So the reason behind opening the FEF account is to record the loss or gain at the time of conversion of the currency. Okay. FEF account by its nature is nominal in nature. That means losses should be, expenses and losses should be debit, and incomes and profit should be credit. Okay, that's nominal account ka rule, right? So FEF account is nominal in nature. Any balance in this account at the end of the year will be transferred to P&L account. Okay, so when at the year end you will close FEF account, so whatever balance is there, if there is any balance, it will be transferred to P&L account. Okay, so now you will have accounting treatments, that is journal entries from the point of view of importer and exporter, as I gave you the example of, me exporting it as an export, me exporting goods to US and me importing goods from UK. Okay, so from the point of view of importer and from the point of view of exporter. So when I am importing goods, I am purchasing goods. Okay, so that is why my journal entry will be import account debit or purchase account debit to the parties account. And when I'm exporting goods, I am making sales. So my journal entry will be party account debit to export or to sales account. Then when I am importing goods, मतलब मैं गुड्स खरीद रही हूँ. अगर मैं गुड्स खरीद रही हूँ मतलब मैं पेमेंट करूंगी. I will be making payment. So my journal entry will be parties account debit, cash bank debit because cash is going out. And if there is any loss, I will record loss in FEF account, and if there is any profit, I will record profit in FEF account. Okay, I just told you just a few minutes back that FEF account is opened only to record losses or gains at the time of exchange rate of the currency. Okay. Similarly, when I am exporting goods, I am doing sales. When I am doing sales, so I will receive payment. Correct? That means cash bank will be debited. Why? Because money will come in. And if there is any loss or any gain, it will be accordingly debited or credited to FEF account. Okay. And at the end of the accounting year, FEF account will be transferred to PNL. Okay. So when you are, yeah. So when you close your FEF account, so either there will be your balance will be on the debit side or it will be on the credit side. Okay. So these balances will appear accordingly. Okay. Yeah. I hope the theoretical part is clear to everyone. I repeat, you will be passing journal entries as per mentioned in the question, either as from the point of view of you being an importer or from the point of view of you being an exporter. Okay. So when you're importing, you are purchasing goods. So when you're purchasing, you will be making payment of the goods. When you're exporting, you are selling goods. So when you're selling goods, you will be receiving payments. Okay. So in the next session, I will take up sums for the same with respect to AS-11.